Guest is Fred Dickson, the Chief Market Strategist over at D.A. Davidson. And, you know, Fred, something that caught my attention is that you guys expect interest rates to move up during the first half of 2010. I know when we talked with John Brynjolfsson, he doesn't expect rates to go higher until 2011, but you expect them next year.
Well, I was expecting the Fed to really throttle back a little bit faster on its quantitative easing programs when the Fed has been such a massive buyer of Treasury and MBS securities that it's kept yields down, and part of our timetable is just trying to gauge when that throttling back would occur. Today's statement said that they've extended it out for a quarter. So in reality, we probably are going to look for interest rates instead of moving up, and not in a dramatic way, but starting to ease up in the first 3 months of the year. It'll probably be Q2 and Q3 as those programs wind down. We did hear today, though, the Fed was going to back off of its purchase of treasuries. And all I can think of is you take a buyer out of the market, and then at some point they're at the same time talking about doing reverse repos or selling on a short-term basis those same securities. They become a seller, and the purpose there is to move rates up. So in some ways, we're getting the action and the double talk that may lead to some confusion as to where rates are. And I think that probably we're seeing rates at their lowest point in the cycle right now.
You also see stocks continuing to move up through the beginning of 2000, well into 2010. Are you concerned that that's when we see the end, though? I mean, when the stimulus money runs out, when the Fed starts reversing its quantitative easing, when they start actually raising rates, is that the end of the party for stocks?
Well, I don't think that the Fed's going to come in and dramatically raise rates. I think at that point we're probably going to see more better signs of just sustainable economic activity at a low rate. We're going to see some slow revenue growth, and because companies have really throttled back on their cost structure, that should translate into earnings growth. When we put that together with a more robust global economic picture, it does spell a good environment, or a better, a sustainable environment for stocks. One of the things that we keep hearing from our retail clients and from institutional investors out on the West Coast are that they're going crazy holding cash, money market instruments that are paying them 10 basis points. They have to put it to work.
But do they want to?
The answer is yes. And they want to do it, though, selectively, and they want to get a better sense that the economy is going to be sustainable. Frankly, what they're really concerned about are what are the next round of government actions in terms of the various programs, health care, energy, taxes.
So they're still holding off for the moment.
They're still holding off, waiting to see what happens in Washington, and they're looking for a little bit stronger signs of economic growth before they put it together. But at the same time, they're being penalized because they're not being paid on the money that they're holding. So it's a catch-22 for a lot of investors.
Yep.
All right, Fred, thanks so much for joining us. Fred Dickson there from D.A. Davidson.